Hello, my name is Daniel Medmoni Ziegler, and in today's video, I will be evaluating Coca-Cola's financial reports and stock value. Before I begin, a little introduction. Coca-Cola was established in 1892, Atlanta, Georgia. Its market share in the past 10 years has been approximately 42%. It operates in more than 200 countries and has roughly 200 brands. It employs 700,000 employees, and it has some significant partnerships, as you can see here. Regarding its stock price, as of December 6th, 2020, the company's stock price is valued at $53.85. Now, regarding all of the statements, the balance sheet, the income statement, the statement of cash flow, one thing that stood out the most was that there were so many inconsistencies in so many line items. It's like one year was higher, then a subsequent year was lower, and then another subsequent year was higher again. So it made the analysis and the forecast pretty tricky and pretty complex. This is the historical income statement 2017, 2019. As I just said, inconsistent figures, fluctuation. Revenue started higher in 2017. They were lower in 2018 and then higher again in 2019. I'm sorry for this typo here. Gross profit was higher in both 2017 and 2018. Operating income was higher in both 2017, 2018, but income before taxes was higher in 2018, 2019. So overall net income was higher in 2018 and in 2019. And here we can see the figures. And in 2017, there was something pretty odd. So income taxes was 5,607 million, and it explains why the company's net income was eventually lower than 2018 and 2019. Regarding the historical balance sheet 2017, 2019, it has a similar trend pattern as the income statement does. So many numerous fluctuations, inconsistencies. Cash and equivalents started lower in 2017, increased in 2018, and decreased again in 2019. Here we can see the figures. And more total cash equivalents and short-term investments in 2017 compared to both 2018, 2019. Again, it just shows how there is a roller coaster with regard to line items, and overall there were better performances under total current assets in 2017. We can see here the total assets in 2017, 2018, 2019. So over time, it decreased. And under total assets, the two significant accounts were goodwill and trademarks. Both increased by more than 75% and 35% respectively, suggesting that Coca-Cola spent more, invested more in acquiring assets and so on. And under current liabilities, there was a gradual increase in accounts payable and accrued expenses from 2017 throughout 2019. Notes and loans payable decreased from 13,205 to 10,994 in 2019. So there was an overall decrease in notes and loans payable, which supposedly is a good thing. Long-term debt is somewhat significantly higher in 2017 compared with 2018, 2019. Here we can see total long-term in those 3 years. So overall, it's a pretty good sign. Common stock was constant, $1760, And obviously all of those figures in this video are in millions. Capital surplus gradually increased, so it suggests that Coca-Cola sells more stocks at premium. And overall total assets, liability, and equity in 2017, 2018, and 2019 are as follows. So we can see that 2017 was a better year than 2018, but then again, in 2019, there was a slight increase, slight improvement compared to 2018, but still lower than 2017 figures. Regarding cash flow statement 2017-2019, same pattern as with the income statement and balance sheet. Fluctuations, fluctuations, fluctuations. It's something that was characterized all over this analysis. An important detail, there were some distorted calculations. So they were not being computed as delineated by the SEC. I don't know if it means that Coca-Cola distorts its values, its line items, maybe it calculates them differently. But according to this analysis, following the SEC, there were some calculations that were not in line. They did not match those figures that Coca-Cola declared. Also, net income did not match those value on the income statement. Obviously, we use net income from the income statement in the analysis of the cash flow. There was a significant decrease, a change between current and prior period in deferred income taxes, which is a good sign, meaning that obviously if deferred income taxes decreases, it means that a company pays more in taxes, which is not good because it means that eventually the company has less cash on hand. So here there was a good sign because the opposite occurred. There were some losses on sales of assets in 2017, 2018. It benefits the company because Coca-Cola can be credited for the loss. And net cash provided by operating activities for 2017, 2018, 2019 is as follows. So overall, there was an improvement. Investing activities, they significantly varied. Purchases of investment decreased by more than 70% from 2017, 2019. So did proceeds from disposal of investments, 58%. These two accounts are basically, corresponding each other. It might imply that Coca-Cola needed less cash to sustain its operations, which is good. The remaining line items showed inconsistencies as well. Net cash provided or used by investing activities is as follows. Again, in 1 year, in 2017, it wasn't um, positive, and then in 2018, it was positive, and then in 2019, again, it was negative. It doesn't necessarily mean that it's a bad sign because we usually expect a company to invest, to spend more money in investments, and this is why we would see some negative values under investing activities. As I said before, and overall this analysis, financing activities were somewhat more stabilized. It means that there is a good chance that Coca-Cola had more control over them, but they were still characterized by fluctuations in all line items. So net cash used in financing activities is as follows. And this is a table that shows what Coca-Cola started with in 2017 and what it ended with in 2017 and 2018 and 2019. Basically, it's cash on hand. So we can see that in 2017, there was less cash on hand, which is not good. And then in 2018, there was more cash on hand, which is good, it's better. But then again, in 2019, there was less cash on hand. Again, it's pretty surprising because Coca-Cola is regarded as one of the largest companies, a mega company, and these analyses maybe shows some other side of the company. So the assumptions for the future were that the future data would keep fluctuate, and there is a cycle occurring because some years are weaker, some years are stronger. There is not any steady growth or decline. There are just ups and downs, ups and downs. And this is the assumption for the future. This is the pro forma income statement using the baseline model. Worth mentioning, all line items increase in 2020, followed by two consecutive decreases in 21, 22. The implications are that Coca-Cola will have lower cost of goods sold, which is supposedly a good sign, but then lower gross profit, which is a bad sign. Then again, lower selling, general, and administrative expenses, which is a good sign. But operating income and EBIT will be lower in 2020, 2022 compared to both 2018, 2019. Net income for 2020, 2022 is as follows, and it is lower than 2090's figures. It's in line with the assumption, but again and again, it shows how fluctuated, how volatile Coca-Cola's financial reports are. And this is just a graph that shows the differences, a comparison between the baseline model, the optimistic model, and the pessimistic model, ups and downs, ups and downs. Regarding the pro forma balance sheet and the baseline model, overall better future performances compare with 2017, 2018 balance sheet, which is a good sign. Cash and equivalents had a somewhat similar characteristic as that of 2017, 2018, 2019, I'm sorry. 2020 will start higher, then decrease in 2021, and then will be followed by another decrease in 2022. By this point, I guess it's not surprising. Total cash equivalents and short-term investments will be lower in 2020 throughout 2022 compared to 2017 throughout 2019. Accounts payable slightly decreased, so did note and loans payable, which is an overall good sign, less debt, less obligations. Long-term debt and other liabilities decreased in 2020, 2022 compared to 2019, suggesting, as I just said, that Coca-Cola will have fewer future obligations, which is an overall a good sign. Common stock remained constant. Capital surplus was significantly lower than in 2020, 2022 compared to 2017, 2019. It might signify that the stock's value would be lower in the future because right now the company is selling at premium, and if it has less capital surplus, it means that the company will sell its stock at a value that is less than a premium. So there is a good chance that the stock value will be lower in the future. Treasury stock will keep decreasing at an increasing rate, and Coca-Cola total assets, liabilities, and equity will be as follows. So overall, we can see there is an improvement, a pretty good improvement in the future. And this is, again, a graph that summarizes the baseline model, the optimistic model, and the pessimistic model. Overall, all models, they predict an improvement, and it's a good sign for the company. And all of them are pretty much better than 2017, 2018 figures. Lastly, pro forma cash flow statement, the balance sheet model. Depreciation and amortization were fairly consistent with 2017, 2019 figures. This is because I couldn't find a depreciation schedule, so I assumed this account, the value will be fairly constant. Stock-based compensation expense was fairly consistent too. Under operating activities, Income taxes will decrease in the future, which does not benefit net cash provided by operating activities. Significant gain or losses on sales of assets will also result in higher figures compared to 2017, 2019. This is based on the CEC. Again, Coca-Cola's calculations are slightly different. I followed the SEC, calculations. Similarly, net change in operating assets and liabilities will be completely different than their 2017, 2019's 90s values. It does not benefit Coca-Cola. The implications are just that the net cash provided by operating activities will be as follows. We started, we will start high in 2020, then this amount will go down in 2021, and then it will go up in 2022. This is in line with the assumptions. Under investing activities, all line items are very consistent with 2019 figures, and thus net cash used in operations in 2020, 2022 resembles that of 2019. We can see these are the figures and they are very similar to 2019 figures. Financing activities are fluctuated. Some of them were due to adjustment purposes. So there was a slight difference between the actual net cash that was supposed to be at the end of the year and the net cash on hand that I initially found. So I just had to adjust for it to reconcile some accounts. And this is why there are some differences between accounts. But overall, less issuance of debt and repayment of debt, and more money will come from sale of treasury stock, which is a good sign. So we can see here in the future, 2020, 2021, 2022, we're going to end up with higher cash on hand in 2020, then lower in 2021, and then lower again in 2022, which is not a good sign. And overall, again, it's in line with the assumption and the overall perspective or perception of Coca-Cola. It's a very fluctuated company, and this is the result. Regarding the intrinsic value, according to this model, the share price of Coca-Cola should be 12.91, 13.32, and 13.11, which is significantly lower than the current stock value, which is 53.85. So it could be the case that the current stock value is overvalued, or it may possibly be the case that this analysis that I created was slightly pessimistic. But surprisingly, after I adjusted the free cash flow model by adding 15% to cash, inventory, and accounts receivables, and reducing 20% from accounts payable in order to supposedly arrive at a higher stock value, a more representative stock value, the stock value did not change much. So even though I started increasing and adding more to cash and inventory and reducing from accounts payable, the stock value barely changed. And in order for the company's current stock price to hold true under the free cash flow model, the estimated intrinsic value of equity should be $216 billion, which is absolutely not in line with neither Coca-Cola's past financial reports nor its forecasted future financial reports. So the conclusion, it was decided that Coca-Cola's share price is overvalued. It might not be 12 or around $13, but it is definitely not around 53.85. It should be lower. And this is the free cash flow model. I want to show here something. This amount is negative. Even if I had created this amount, or if I had changed this amount and made it positive, the stock value would still haven't been higher. So it didn't change a lot. these are what I used for the free cash flow model and the stock valuation. Like I said, cash, accounts receivable, inventory, and accounts payable. Even if I change these accounts and added 20% more to these three accounts and reduced 20% from accounts payable, it still didn't change the overall, the final stock value. So it just tells me that the stock of Coca-Cola is overvalued, as I said, and this is the intrinsic value of equity. This is the amount that I just said that it should have been 216 billion in order for the stock value to be around $50. So it's just completely not in line with the assumption because here we have 53 billion, 56 billion, 55 billion. And this is all I have for today. And I hope you enjoyed this video. I hope you learned something new. And I appreciate you for watching it. And that's all I have. Thank you so much. Bye bye.